The trend that has been underway in the macroeconomy since approximately June, where the negative expectations culminated about June, and then we've seen a gradual improvement in sentiment since June until the election, and has actually been accelerated after the election, so that we saw that interest rates and interest rate expectations, inflation and inflation expectations, and leading indicators were generally dropping until June, something like that, and they have since been improving until the election and then accelerated by the election of Donald Trump. So we've seen the 2 to 10 year spread, a curve steepening of 25 basis points in the US. We've seen long-term inflation expectations increase by 25 basis points approximately since the election of Donald Trump in the US, and about 20 basis points in Europe. So Europe is also benefiting from this trend, and so this is generally leading to a more widespread positive sentiment in the macroeconomy, which can also be observed in the Federal Reserve Bank of New York's GDP Now indicator for the fourth quarter. It's based on high frequent macroeconomic data, and shows that the expected GDP growth annualized in the fourth quarter of 2016 has increased from about 1.6% to about 2.6% in a matter of only 1 month. So something is really happening, especially in the U.S. economy, but that is going to have ultimately a large impact on the rest of the global economy. The macroeconomic trend that has been underway since June and that has been accelerated since the election of Donald Trump was one of high interest rates and leading indicators and inflation expectations, and those are the three major macroeconomic drivers behind the minimum volatility equity premium. So minimum volatility stocks were benefiting from lower interest rates and inflation and leading indicators up until for about a 2 year period until June, about June, and then this trend has been reversed in the macroeconomy, and that has then hurt minimum volatility stocks. Quality stocks are sharing some of the features of minimum volatility stocks, so they're also hurting in this environment. And the stocks that are benefiting from this development, those are especially small cap stocks and value stocks, which have been relatively cheaply priced, and at the same time are less rate sensitive than the general markets, so that when rates go higher, that is especially benefiting, at least in a relative sense, value stocks compared to the rest of the market, and especially growth stocks. And small cap stocks are performing quite well because they are perceived to be less prone to be hit by protectionism, because they are less global in their coverage. There's some nervousness in Mexico and China. Mexico, because of the obvious implications from an implementation of the protectionist measures that Donald Trump has proposed, and the wall and all that, it's already being priced into the Mexican peso, and you might argue that is by now too much, perhaps. Regarding China, which is feeling some of the rhetorics from Donald Trump, the market has not really been responding too much in China, and that is because it's not obvious that, despite the fact that Donald Trump is saying that they are manipulating the currency, that they're actually doing so. So the market is not really believing that if they let the Chinese renminbi float, that it would be another place than where it's actually trading by now. So it's not obvious that China is really going to feel a lot of that burden. And if we look at the macroeconomic development, some of the analysts have been saying that higher interest rates are bad for emerging markets, and stronger dollar is bad for emerging markets, and that's not really obvious, because if we look at historical correlations, they're actually showing that emerging market stocks, at least, are doing quite well in periods of a strong dollar and also higher interest rates.